This headline I saw on Bloomberg Markets today: China's gold binge extends to 7th month as holdings climb. That would lead traders and investors to believe that a large entity like China buying up gold would surely see prices climb. Or they might use that as an explanation for the rise in gold prices from October 2022 to April 2023 so far. But is it realistic to think that China's gold buying really is pushing up prices? If you've been watching my channel for a while now, you'll know that I prefer to rely on data and facts, not feelings. This is a wildly unpopular view, despite appearing to be logical. So let's look at some facts. Let's start with a very short clip from my online course, Learn Pure Elliott Wave. This is from lesson 1, where I try to convey the concept of the underlying principle of the Elliott Wave theory, that it's social mood that drives markets. This is a chart of the Shanghai Composite from 2015 to 2019. So I use a study of how the Chinese Communist Party managed the crash of the Shanghai Composite from the high in June 2015 at 5178.19 to the closing price in January 2019 at 2464.36. The SSCC lost 52% of market value, greatly exceeding the technical definition of a bear market, which is a 20% drop on a closing basis. So let's jump into this little clip from the online course that I have for you. Let's take a brief look at the crash of the Shanghai Composite in 2015 to 2016. This is a weekly candlestick chart of the Shanghai Composite from mid-June 2015 to the end of January 2016, the period of a large bear market. On 4th of July, CSRC convened 21 major brokerages and 25 mutual funds to discuss further measures to try and halt the market crash. The gist of the pledges was a further raising of funds up to 120 billion RMB, purchasing of ETFs and stocks, and a further halt on selling. On 7th of July, China Insurance Regulatory Commission allowed insurers to invest more in blue-chip stocks. On 8th of July, coordinated intervention by several institutions on this date, including the central bank, made it clear they would provide the CSRC with liquidity to support the market. A raft of measures to inject liquidity into the stock market were announced. Despite the massive government intervention in the market just outlined, clearly, price continued to fall through to lows in March 2016, with further lows found in January 2019. If massive government intervention in the Shanghai Composite through 2015 and 2016 did not drive the direction of price, then what was driving price? The underlying principle of the Elliott Wave theory states it is social mood that drives the direction of price, and there is some evidence to support this theory. The information of the interventions by the Chinese government comes from this paper, Do Government Interventions Affect China's Stock Market? Case Study Analysis of the Assets Bubble from 2015 to 2016. As I note, though, prices did continue to find its eventual low in January 2019, but this paper only covers this period of time of that bear market. The interventions I've mentioned were just a small minority of a range of interventions that are outlined in this paper. Date by date, intervention by intervention. There's a lot of information here. The gold market trades $149 billion a day. It's a truly massive global market, one of the biggest in the world. The Shanghai Composite is also a big market, absolutely, but it's not nearly as big as gold. The Shanghai Composite trades on average $826 million a day, and so the gold market is 444 times the size of the Shanghai Composite. So if the Chinese government could not stop a bear market in the Shanghai Composite, it would be a reasonable conclusion to draw that the Chinese government would not be able to push up gold prices sustainably. So what does drive prices? The underlying principle of Elliott Wave is that it is us, people as a herd, our social mood that drives prices, and this social mood unfolds in repeated patterns which can be charted using Elliott Wave rules and guidelines. That's what we do at Pure Elliott Wave. We're extending our analysis of gold from once a week to 5 times a week, and when we offer this new service as a subscription, we'll offer a grandfather rate. This rate will be offered only for 48 hours, so make sure you don't miss out on getting it. Click on the link below to get notified of when we launch this service, and thank you for your support.